Level 1. The First Saver, $10,000. You are 23 years old and you have $10,000 in a savings account that pays 0.04% interest. It took you 19 months. The number is the largest you have ever seen attached to your name. You earned $52,000 last year and you remember exactly where the rest of it went because you had no choice but to remember. Rent, insurance, the brake job in March, the flight home in August because your mother said, "Come if you can." You went. You came back $740 lighter. The math is the only conversation you have with the future. Your roommate is a man named Devin who works in restaurant management and pays his half of the rent in 2 transfers because he gets paid every other Friday. You met him through a listing you do not tell people about. He is fine. The apartment is fine. Fine is the word you use for a life you are trying to leave without saying so out loud. You open a brokerage account on a Tuesday in February. You move $400 into an S&P 500 index fund because a video told you to. The video had 1.4 million views. You add $200 every 2 weeks for the rest of the year. You do not check the balance more than once a week, then once a day, then once an hour, then back to once a week when the discipline finally lands. By December, you have $14,800 across savings and investments. The market did most of the work. You earned the rest by not interrupting it. Your father calls in November to ask if you can help with the heating bill. You send $300. You do not log it. You do not ask when you will get it back. You understand the same week you understand compound interest that money is not arithmetic. It is gravity. You are not poor. You are not free. You are the version of yourself that the next version will look back on with something between gratitude and embarrassment. You have crossed the first threshold, which is not the threshold of wealth. It is the threshold of having something to lose. Level 2. The comma. $100,000. You are 28. Your salary is $94,000 base, plus a bonus that lands somewhere between $8,000 and $14,000, depending on how the year closes. You have $107,000 across a 401k, a Roth IRA, a brokerage account, and the cushion you stopped touching in 2021. The number has a comma in it. The comma matters more than you expected. You moved cities once. You changed jobs twice. The second move added $22,000 to your base. Nobody was supposed to tell you this works, but it works. You learned it the way most people learn it, which is from a friend who learned it from a friend who paid $400,000 for an MBA to learn the same thing. You date a woman named Priya for 18 months. She is a project manager at a healthcare company and she earns slightly more than you do. You split bills the way 2 people who have read the same article split bills. It is mature. It is correct. It is not how your parents did it, which both of you mention exactly once in a way that closes the topic forever. The first 6-figure number does not feel like wealth. It feels like permission. Permission to stop calculating coffee. Permission to fly home for a weekend without the spreadsheet opening in your head. Permission to say the word emergency and mean an inconvenience instead of a catastrophe. You read a book about index funds. You read 3 books about index funds. By book 4, you understand that the answer was on page 11 of book 1, and the rest is repetition. The asset allocation almost does not matter at this level. The deposits matter. Your job is to keep depositing. The market is doing arithmetic you do not need to supervise. You buy a watch, $1,800. You wear it twice a week. You think about your father's wrist for the rest of the year. Level 3. The Millionaire, $1 million. You are 36. Your net worth is $1.04 million. The number sat below the line for 2 years and then crossed it on a Wednesday in March because the market moved 2% on a single trading day and you happened to be holding a right index. You did not check the balance until Friday. You did not tell anyone for 2 weeks. The first person you told was your sister. She said congratulations the way someone says congratulations when they do not understand what is being congratulated. You are not rich. The internet has explained this to you. The financial media has explained this to you. $1 million is the new $250,000. $1 million will not retire you. $1 million in this city pays for a 1-bedroom condo with a parking spot and a property tax bill you read carefully. The internet is wrong about exactly one thing. The first million is the only million that ever feels like a million. Every subsequent million is a unit of measurement. The first one is a door. You walked through it. The door closed behind you. You can never walk through it again. A man named Theodore Park enters your life through a friend of a friend. He is 51. He is a wealth advisor at a regional firm. He charges 1% of assets under management, which you know is too much, and he says things that are correct often enough that you do not fire him. He runs a financial plan. He shows you a chart. He says the words, tax efficient, 8 times in 40 minutes. You learn that you have crossed a tax threshold you did not know existed. You learn that the 401k match you ignored at your first job cost you $14,000. You learn that the woman in the cubicle next to yours, who never seemed to do anything, is going to retire 7 years before you because she started at 22 and you started at 26. You start thinking about real estate. You stop thinking about it. You start again. The math does not work in this city. The math works in 3 other cities you do not want to live in. You file the question away. You are 36 and you have $1 million, and you have learned that the question is no longer how to make money. The question is what to do with it. Level 4, the 8 figures, $10 million. You are 44. The number is real. Some of it came from equity in a company that exited. Some of it came from 18 years of contributions and 1 decade of compounding. Some of it came from a real estate decision you made in a year you barely remember. The number changes how the financial system speaks to you. You are no longer a customer, you are a client. The distinction is not semantic. A customer is sold to, a client is invited. A woman named Marielle Acosta enters your life. She runs a private wealth team at a name you have heard your entire adult life. She does not call you, her assistant does. The first meeting is 90 minutes in a conference room with a view of a river. Marielle is 47. She has been at the firm for 19 years. She knows your account size, your liquidity profile, your tax situation, and your wife's maiden name before she shakes your hand. She does not pitch. She listens. You are introduced to private investments, funds you cannot access through a public brokerage. Minimum commitments of $250,000, lockup periods of 7 to 10 years. The returns are not always better than the public market. They are different from the public market. That distinction is the entire pitch. You buy a second home, not a vacation house, an asset. You learn the difference the first time the property manager calls about a leak and you do not feel anything except mild irritation that the call interrupted lunch. The house is not where you live, it is where the money lives. The friends you had at level 2 have started the space themselves. Some moved up with you, some did not. The ones who did not are not jealous, they are tired. The conversations have become unequal in ways that nobody mentions because mentioning would make them worse. You are invited to fewer dinners. You stop noticing this around year 3. Your father turns 71. You buy him a car. He drives it twice a month. He keeps the old one in the driveway because he does not trust the new one yet. You understand this without asking. Level 5. The Centimillionaire. $100 million. You are 52. The number is $130 million on paper, $84 million liquid, the rest in private positions, and 1 operating business you still partially own. You stopped checking the balance daily at $20 million. You stopped checking weekly at $50 million. You check quarterly now. Marielle sends a report. You read the first page. Wealth at this level is no longer measured in what you own. It is measured in what you do not have to think about. You do not think about flights. You do not think about hotels. You do not think about the mortgage on the second home, or the third home, or the cabin your wife wanted in 2019. You think about 3 things: your children, your health, the 4 people who report to you inside the family office you opened 18 months ago, and which costs $1.4 million per year to operate. The family office hired a chief investment officer named Henrik. He is 49. He came from a university endowment. He earns $480,000 plus a performance allocation. He does not report to you the way an employee reports to a boss. He reports to you the way a doctor reports to a patient. The information is technical. The decision is yours. The recommendation is implied. You make your first $5 million single investment decision in November. Direct equity in a logistics company. You spent 6 weeks on diligence with Henrik's team. You said yes on a Tuesday at 4:11 p.m. in a conversation that lasted 9 minutes. The investment will return 2.7 times in 4 years. You will not learn this until later. At the moment of the yes, you only know that the room around you has gone quiet in a way that is not silence. It is consequence. Your daughter is 19. She does not know the number. You and your wife agreed when she was 12 that she would not learn the number until she asked. And she has not asked, and she may never ask, and the conversation about whether her not asking is a problem is one you have only with yourself, late, in rooms where nobody else is present. Level 6. The Billionaire. $1 billion. You are 58. The number is unstable. It moves $40 million on an average trading day. It moved $180 million the morning the macro report dropped. You stopped feeling the movements at $200 million. The numbers became weather. You did not become a billionaire by saving. Nobody does. You became a billionaire because a private holding you took 12% of in 2009 grew into a public company worth $14 billion, and your stake survived 3 rounds of dilution and 1 near disaster you do not discuss publicly. The wealth is not your salary. The wealth is the equity. The equity is the bet you made before you had earned the right to make it. You operate behind a holding structure with offices in 2 jurisdictions. You sit on 3 boards. You are a limited partner in 11 funds. You are the anchor investor in 2 new ones because the firm raising them would not have closed without your commitment. The general partners called you on the same Tuesday. You said yes to both before lunch. A woman named Eliza Vance manages your philanthropic foundation. She is 56. She left a federal agency to take the role. She is paid $370,000 per year, and she will not stay if you treat her like staff. You do not. The foundation will give away $42 million next year across education, public health, and one specific cause your wife has cared about for 30 years. You eat dinner alone twice a week by choice. The silence is the only place where the numbers do not arrive. Your wife understands. Your children, who are now 24, 27, and 31, do not understand yet. They will, or they will not. Either outcome has been planned for in documents you signed in the presence of 3 attorneys in 2021. The strange thing about being a billionaire is that the door does not open further. It closes around you. The room shrinks. The number of people who can speak to you honestly drops below 10. You count them once a year on a flight. You do not write them down. Level 7. The Architect. $10 billion. You are 67. The number is no longer yours. The number belongs to a structure of trusts, holding companies, and operating entities that bear your name but answer to a governance document drafted across 14 months by a team of attorneys in 3 countries. You are a signatory. You are not the owner. The distinction is the architecture, and the architecture is the point. You did not become this. You constructed it. The first $1 billion was an outcome. The next $9 billion was a system. The system is a private investment vehicle that compounds at a rate the public market cannot reach because it owns the public market in fragments and the private market in pieces and the credit underneath both. The system has 240 employees. You have met 31 of them. You do not think in terms of investments anymore. You think in terms of generations. Your grandchildren are 4, 6, and 9. They will inherit not money, but a constitution. A document that defines who decides, who signs, who is heard, who is constrained. The document was harder to write than the wealth was to build. The wealth grew because compounding is mechanical. The document grew because human beings are not. A young woman named Ines, 28, joined the family office last year as an analyst. She is your second cousin. She earned the position through a process you designed specifically so that no one in the family could earn it through the family. She does not know yet that you read her memo on emerging market credit and quietly rerouted $80 million based on her recommendation. She will learn in 6 years. You will be 73, or you will be gone. You have seen what happens when the architecture fails. Names that meant something in 1980 reduced to liquidation statements in 2014. Cousins who sued each other over vacation properties. Foundations that became battlegrounds. You will not allow this. The document will hold. The machine no longer needs you. It needed you to build it. It does not need you to run it. That distinction took 40 years to accept. Somewhere, right now, a 23-year-old is staring at $10,000 in a savings account and trying to decide whether to move $400 into an index fund. He does not know the document exists. He does not know the architecture exists. He does not know that the wealth he is trying to build is a smaller version of a system that was solved before he was born. He will learn what he can. He will build what he can. He will cross the first threshold, then the second, then the third, and at every level he will believe the level above is the one that finally feels like a rival. It will not. It never does. The number is not the wealth. The wealth is what the number permits, and what the number permits is more wealth. And the chain ends only when the architecture takes over and the human steps out. The chair will be filled. It always is. So, there you have it. The life journey of a billionaire. Next video is going to be more exciting than this one. If you enjoyed this one, make sure to like and subscribe. See you in the next video.